initial line up here. Here's our entry point, right? So the difference between these two lines, you can see, is 29 pips. Okay, so we've got 29 pips worth of risk, and if we're coming down here to the top of the zone, which I would put right about in here, you can see that's 47 pips. Okay, so we can see very quickly, here's our risk, and here is our target. Well, you can see quite obviously, let's round this up to 30. So if we're risking 30 pips to make potentially 47, that's not exactly a good risk-reward ratio, is it? We're risking 30 to make 47. Ideally, if we're going to risk 30, that would mean that we're going to make 60. Oops. 60 would be the ideal, right? But we're not getting that. So at this point, what could we do as traders? Well, the first thing would be to just pass on the trade, to not take it, because it is too much risk. The next thing to do for most traders, which I think is the wrong thing to do, would be to say, well, I'll stop out if it only comes up to here. Okay? I really think that that's the wrong answer, because this is a much riskier stop. Now, let's talk about why this is a riskier stop. There was a guy back in the 20s. His name was Wyckoff. And Wyckoff studied the market like all of the guys back in the 20s and 30s did by hand. And, while I don't do it, there is something to be said by tracking things by hand on graph paper. You get a very physical understanding of what the market is doing, and I think it really can be beneficial. Now, I do my exercises on the chart. I've done a lot of exercises that way, and I think there really is no drawback to doing it that way. But anyway, what Wyckoff said was that the market, if it does break through a support area like this, so if it breaks through here, that it's going to want to test or retest what I call the prior area. And simply put, it's because if you're talking about getting a real move, meaning a sustained move, or what Elliott calls an impulse move, like you see here, usually what will happen is that the market will, let me just clean all of this up. Okay, so we've got our risk, we'll put that back on there, and our target. Okay. What Wyckoff is talking about, and you can sort of see that the market did push back up a little bit here. Whether or not that happened after the break, I don't know. But what he would say is that if the market is going to make a move, and it breaks through a support or resistance point, that the traders who are affecting the orders for their clients, they don't put the entire position on the break. Okay, they're going short in this area, and in this area, and in this area. So they're going short all the way up here. Once the market breaks, they're going to stop selling to see if the market is going to continue down. If it pauses, they will actually come in, and believe it or not, buy the market up to push it in here to see if there are any more buyers. That's why you'll often get the retest, and that's why putting your stop in this area really isn't a good idea. Remember my philosophy on stops. I'm just going to write it out here. Stops. Number one, I don't know why this isn't working. Far enough away from the market that it can't get there easily, and two, close enough that you can afford it. Far enough away so that it can't be reached easily, close enough so you can afford it. And what I mean by afford it is, simply put, if you can afford to risk 29 pips to make 47, based on the amount of money you have in your account, based on your risk profile,